Most investors shake with fear when headlines shout about a market crash. They watch their portfolio light up in red and push the panic button. But if you follow the dividend trifecta, a market crash is actually the best thing that can happen to your timeline toward $1 million. Today, I'm showing you the contrarian math behind why the crisis is your greatest wealth multiplier. I'm also revealing the one critical mistake that causes 90% of investors to fail right before the finish line, and how you can avoid it. But first, let's look at why green numbers can actually be your enemy at the beginning. Most financial gurus tell you the same thing. Pay off every cent of debt before you even think about the stock market. It sounds safe, right? But for the dividend trifecta, this advice is an invisible trap that can cost you a decade of freedom. If you wait 5 years to be debt-free, you aren't just losing 5 years of growth. You are losing the lowest entry prices you might ever see. You're missing the wealth multiplier effect that only happens when the market is bleeding. Now, I'm not a financial advisor. This is my personal strategy, and you should always consider your own risk tolerance. But here's the math they don't tell you. While you're paying off a 4% loan, you're missing out on a potential 10% yield on cost that compounds for the next 30 years. But even if you have the cash ready, there is a specific buy trigger in a crash that most people get dead wrong. If you strike without a plan, you risk ruining the trifecta's unique balance. I'm going to show you exactly how to time your entries to keep the machine running at 100%. So when do you actually pull the trigger? Most people try to catch a falling knife buying everything on day one of a crash. That's how you blow your capital and ruin your balance. Think of yourself as a sniper. You're not looking at the stock price. The price is just noise. You are looking at the dividend yield gap. Every high-quality ETF like SCHD or VOO has a normal yield range. For example, if SCHD usually pays around 3.4%, that's your baseline. When the market panics and the price drops, that yield starts to climb. Your first buy trigger isn't when the news says it's over. It's the moment that yield hits 20% above its 5-year average. If the average is 3.4% and it hits 4.1%, that is your signal. You aren't just buying a dip anymore. You are locking in a yield on cost that will pay you like a king for the next 30 years. I'll show you exactly which ticker symbol handles the recovery best in just a second. And you definitely want to stay until the very end, where I'll reveal the exact dry powder ratio I keep ready for these moments. If you're serious about using math to beat the market, make sure you're subscribed so you can follow this journey to $1 million. But right now, let's look at that third pillar. To keep the dividend trifecta in perfect balance, I follow a strict blueprint that dictates exactly how my capital is deployed. I allocate 40% to VOO. This is the heartbeat of the portfolio, ensuring we never miss out on the broader market's growth. Then I put 30% into SCHD. This is our cash flow engine, providing the immediate dividends we need to reinvest when blood is in the streets. The remaining 15% goes into DGRO. Most people overlook this, but DGRO is our secret weapon for the recovery phase because it focuses on companies with the highest dividend growth potential. But if you've been doing the math, you'll notice a gap. That only adds up to 85%. Most investors make the mistake of being 100% all in at the very top. They have the strategy. But when the opportunity of a lifetime finally hits, they're stuck with no way to buy the seat. The final 15% is the most critical part of the entire system. That is my war chest. I keep this 15% in high-yield cash or short-term bonds at all times. This dry powder is what allows me to strike with total confidence the moment our sniper trigger hits. It's the difference between watching a crash in terror and watching it with a smile, knowing you're securing your path to $1 million. If this strategy made sense to you, hit the like button. It really helps a small channel like this reach more investors. And if you want to follow my personal journey and see the math in action every week, make sure to subscribe. I've linked the full Dividend Trifecta playlist right here on the screen so you can master the rest of the system. Thanks for watching, and I'll see you in the next video.